Recording with Mr. James Koutoulas on Tuesday, March 14th, 2023 at 2 p.m. Eastern Time. And as always, guys, if you want to support the podcast, click on the little red button for locals above. James has been on here several times before. I think the first time you came on, we discussed you taking down the CEO of Goldman Sachs, John Corzine, and Obama's Attorney General, Eric Holder, in 2011 for the eighth largest bankruptcy in U.S. history. You did it pro bono. I think you get the largest amount of
Neither of
funds.
them are in jail though, so I didn't
I,
actually take
I
them
mean,
down. But
well, I mean, the fact that you won and didn't end up, face down in a shallow grave to me is winning. And I put
I'll
the link.
take it.
Yeah, I put the link to that article in the description if you guys want to check out James as well as his Twitter and Instagram. And you created Let's Go Brandon Coin, but you are my financial expert by virtue of the fact that I know next to nothing. So if there's something I haven't added about your background, please add that, and then explain to me and my audience, to the best of your abilities, what exactly is going on.
Sure. Yeah, just the day job is I run Typhon Capital Management. We're a multi-strat hedge fund. We trade primarily listed derivatives like futures and options, as well as crypto. But we're obviously tied into the entire global macro space, of which SVB is a big catalyst this week.
So why is this bank collapsing, and why is this distinct or important than any other bank going under? Why is it making waves? Is this just news?
Well, they're not alone, right? So there's a couple things. So I think the first to look at how the banking system works. So after the 2008 collapse, one of the things that the government did was designate systematically important financial institutions. So like the big four banks, are basically legally too big to fail. Like if they have a problem, we're just going to print more money and prop them up. Okay. Now, outside of those, we do have a Federal Reserve to facilitate short-term loans to banks, but inherently every bank is insolvent. Okay, always, like by definition. Okay, so the way banking works is on this concept called fractional reserve lending, where is if someone puts in $1 deposits, okay, the bank has a liability for $1, but a bank could go out there and make loans far in excess of what their deposits are. And this threshold is essentially defined by banking regulators. It's called the reserve requirement. I want to say right now it's something like 5%, but I could be wrong because I'm not actually a banker. And it's the last minute, so I haven't checked. But let's assume it's 5%, right? If you have a 5% reserve requirement, then a bank can lend out $20 for every $1 in deposits it has, and then it relies on not having all of its depositors ask for their money at the same time. So any bank, if all of your depositors, or even a decently large, but not even 50% of your depositors, ask for their money at the same time, the bank fails by definition, right? Like that's why the Fed was created after the Great Depression, was to create or to prevent banks, from failing. And 1 second, let me just turn on Do Not Disturb because I'm getting a slew of
You're good.
notifications.
Yeah, I know that they set it up in 1913 as sort of to create the US dollar to be like a uniform bubble. So instead of individual banks having their individual notes, a run on the bank or a panic or depression or whatever the terms have been over the decades, the idea was to sort of spread it all around so no one bank could take down the whole system.
Yeah, and actually, you're right. I believe the Fed was created before the Depression. The FDIC,
Yeah.
was created to discourage bank runs, and that basically the way the FDIC works is that you have member banks. They have to pay fees into an insurance fund that then steps up and guarantees deposits. Now, the way the FDIC works is that each depositor per bank gets $250,000 worth of insurance. Now, one of the really unique things about Silicon Valley Bank was that 93% of depositors had more than $250,000 in deposits at the bank, right? So they're thus uninsured under the vanilla language of the FDIC. Now, one of the governmental responses to SVB has been to say, okay, we're going to guarantee deposits even above that, right? And we're going to wipe out shareholders and bondholders, which is good. You're creating moral hazard for the people who supported this bank that did not have good risk controls and good risk management. They actually had a 9-month period where they had no chief risk officer. They just got a new one in like January, right? So there's several governance problems at SVB. But for the financial system, bank runs are bad, right? Because once you have one bank run, it triggers other bank runs. And, we've seen, Signature gone down. We've seen Silvergate go down. We saw all the regional bank stocks get absolutely hammered yesterday because, no one wants to be the last, money in a bank. And again, by definition, all banks will fail if there is a bank run. Now, some contributing factors here. So, one, basically a 13-year period starting in 2008 where short-term interest rates were essentially zero, right? So you got banks could go and lend money back to the Fed, get a little bit of overnight interest, generally between 25 and 50 basis points. So not a lot. Okay. All of the inflation coming out of this prolonged period of low interest rates, coupled with the monetary policy response, where we were raining stimulus checks down on people who were then like speculating in crypto and trading options on Robinhood, and all of this stuff was very, very inflationary. So as a response, the Fed has come out and raised short-term interest rates incredibly quickly. Now, one of the big failures of a lot of these regional banks has been what's called duration mismatch. Okay, so what does that mean? So the general Treasury complex of government debt has everything from overnight loans, which the rates for are dictated by the federal funds rate, all the way up to 30-year Treasuries. Okay. In a healthy economy, you have a yield curve where you get more interest for the longer that you lock up the capital. Now, what happened is, a lot of these banks got complacent. You had 13 years of, zero or close to zero interest rates at the front end of that yield curve. So what they're like, oh, well, we're just going to lock up, these bonds at a longer duration. Now, if you have all these assets in these long dated bonds, and then people come and ask for the money, you can't just liquidate these for 1-to-1 on an immediate basis. Like, they're not cash equivalent. Like, if you're buying 30-year bonds and then short-term rates, yields go up, the prices on these long dated bonds drop, right? So you're actually taking like mark-to-market losses and are then forced to liquidate this long dated paper to meet your short-term depositor calls. So basically, a lot of these banks took a lot of risk, this duration risk, by locking up long-term assets. And then when people started to come for the money, they didn't have the assets to pay them. Now, why did this happen? Right? So one, Silicon Valley Bank is unique in that it would kind of have this circle relationship with venture capital companies, where post 08, you've had a ton of money fly into long lockup alternative investment strategies, things like venture capital, private equity, where an investor will commit money for 10 to 15 years into these funds. That money then goes into generally a designated tranche in the capital structure of businesses. So you'll have dedicated venture funds that are, seed stage or Series A, Series B, Series C, private equity that comes into later stage businesses. And then within those, you'll generally have specialists who they'll focus on seed, or they'll focus on A, and they'll focus on B. So you have this whole ecosystem sprung up where VC, seed stage funds would come in, they'd give companies their first dollar. Okay. But then they'd flip those investments or get, additional capital and higher valuation that allows the VC funds to mark up their valuations after the Series A comes in. Okay, Series B, they're doing their deals at successively higher rounds generally, in Series B. Now, you have all the private capital flowing into these private funds. Well, they're getting these big, mark-to-market valuations on this illiquid, founder companies, founder stock, Series A stock, whatever. Then those VC funds and the VC funded companies go to Silicon Valley Bank, who would then say, okay, well, we're going to lend against this stock now, right? So they're going to lend, and then the VCs, get loans on the stocks, and officers, the company themselves, a lot of times would then just like redeposit this into Silicon Valley Bank or similar regional banks. Now, what happened last week is you had some VC chats, and the VC communities tend to be very close knit and very like herd minded, because they build up this whole ecosystem where it's akin to like greater fool theory, where the C is selling to the A, is selling to the B, selling to the C, and everybody's kind of making money along the way. But they're like, well, all these rate hikes, they've kind of weakened the balance sheets on these banks. You should all take your money out, right? And so you had in one day 25% of the assets come out of Silicon Valley Bank. Like, that's insane. Like, utter insanity. Like, imagine going to Chase and having 25% of Chase assets like come out in a day. It's just like unprecedented.
Then why is this different? Like, why now?
Well, now people are on all these chat rooms, right? And you've had a lot of stress to the system. Okay, like, so the Fed in their fight against inflation, they've raised rates really quickly. So if these banks got greedy, they didn't have proper, risk management where they, kept sufficient, reserves in short paper. A bank run's going to be really damaging, and it's like saying fire in a crowded theater. Like, everybody's like running for the exit, right? Now, Silicon Valley Bank, there appears to be like some other potential major governance failures, right? Like I mentioned, they had like 9 months without a chief risk officer. This is a bank that was very big on like diversity and inclusion and like kind of the woke factors, right? And like we've seen time and time again, when people prioritize woke metrics over profitability, it's saying, okay, well, we're going to give money, we're going to lend money to this company because they got a lot of women on the board and a lot of gays and stuff like that. Well, maybe that's not necessarily the best metric for determining, profitability and good bank risk management, right? And, you also, there's, a lot of apparent political ties here. Like, I believe the first chairman of the bank was like Al Gore's wife, right? Like, they're close in with like California Governor Gavin Newsom. You have several of these executives appear to have dumped like hundreds of millions of dollars of stock, in the last, couple of weeks. Like, was it insider trading? Like, I don't know, but after this bank collapse, right after all these insider sales, does it warrant, investigation? Like, probably.
But will it actually fail if the current administration is very heavy on ESG and DEI hires? In a sense, it doesn't seem like it's going to face the natural ebbs and flows and natural selective tendencies of a free market if the very kind of big dog on campus, the White House, and thus, the Fed and Department of the Treasury, if they're for this, are they going to let it fail?
Well, so they sort of have let it fail to an extent that it appears that like shareholders and bondholders are getting wiped out. Okay, so they're going to bear losses. Okay, it does not look like the companies that had money there are going to like lose their deposits, right? Which is, it's generally a bad thing for an economy. And look, I'm all about moral hazard, right? But if you say like, thousands of businesses can't make payroll, that tends to have a lot of second order effects. And, what really caused 2008 is, those, rolling bank failures. Is it just like black and white there that it's like, okay, wipe out depositors, wipe out bondholders, always, insure deposits 100%? No, because, you've got to ask some questions about, this new facility that's been put in place, right? Like the administration's trying to say, like, taxpayers aren't going to pay this, member banks are ostensibly going to pay it. We'll see if it actually shakes out that way, but they've put into operation this lending facility that is going to let other banks go. And if they do have these like 10-year pieces of paper, right, that they can't liquidate immediately, they're going to essentially let them treat that as cash. And that does create a lot of moral hazard, right? That's basically saying, okay, well, you could go out on the term structure, lock up depositors' assets, a long time for yield, and then, oh well, if interest rate risk rises and you don't hedge, right? There's ways to hedge it. Like we trade futures. Like there's multi-trillion-dollar derivative market that you go out and and pay to hedge to like reduce that risk, right? You're saying, well, why hedge? Because your hedge, you have the ultimate government put, that the government is going to be your hedge, and they're going to like bail you out if something goes wrong.
So is this a closed-minded view or a simpleton view that this is just a never-ending game of kicking the can down the road the next couple of years or decades, just hand it off to another administration, bubble this, collapse that, pandemic this, war preparations that? Is this just a game of you just kick it down the road forever?
Well, so kicking the can has been a thing for a long time, right? I mean, like
Yeah.
the savings and loan scandal, which was going to be before my time in the 80s, that was
Yeah.
really like the first, kind of government bailout. And you had, like in '08, some of these bailouts were absurd, right? Like the early bank bailouts were actually similar to this one, in that they wiped out, bondholders and stockholders, like basically like Washington Mutual, Bear Stearns, like basically they, wiped out or close to wiped out the stock and bondholders, but guaranteed depositors. Um, to me, that's pretty decent, right? Because the people who are making, these decisions to manage the bank in a risky fashion, they do have consequences. Politically, I think, even with the ESG bent, you do get a lot of political capital by saying we're going to go after these executives who sold stock ahead of the collapse, for insider trading. So I do think there's a reasonable chance that gets done, even though they do appear to be very politically connected to the current administration. Um, in terms of can it go on forever? I mean, to me, if you want to look at this a little more sinister, is like Coinbase, for example, has changed, has had 3 different depository banks in the last week, right? So um, to me, it reeks somewhat of an attack on crypto. And you've definitely seen a massive, regulation by enforcement strategy, by the SEC, who are really going after a lot of, people in crypto, even like legitimate products, even projects that are clearly not securities. And they are, really trying to curb Americans being in crypto. So, if you really want to get conspiratorial, like everybody's talking about like the Great Reset, right? Like, well, when you do kick the can forever, like when is enough enough, right? Like things eventually break. Um, so if you look at from my perspective, the most likely conspiracy theory is that eventually, if you do have enough, bank failures where you've got to do another wave of government stimulus, like what happened, in COVID, right? You say, well, we're going to give you government stimulus, but it's going to be a central bank issued digital
Yeah.
currency, or a CBDC, which to me, like that's what the left really wants. Like that's what you have in China, social credit, where if you criticize the government, we're
Total
taking your
control.
money.
Total
Okay.
control.
And, to me, this is a potential like domino towards the government's. The government absolutely wants a central bank digital currency. I mean, Treasury reached out to me in 2017, okay, to talk about central bank digital currencies and stable coins. And look, I've been in that space for a while. Am I the world's #1 guy on stable coins or central bank digital currencies? No.
Yes.
Right. So, I mean, they've been looking at this bare minimum 6 years, which means it's probably like, 8 years, 10 years plus, right? Because My buddy Madison Cawthorn says, as a quote, he says all the time, government's got a monopoly on two things, violence and money, right? Like with the military, right? So they don't want people making their own money, through crypto, and they don't want people owning guns, right? Like that's how, you get total control of the civilizations. You take away guns and you do something like a central bank currency, which is way more powerful from an authoritarianism standpoint than like just printing dollars, right? It's
Oh
one thing
yeah,
to say you can't counterfeit a dollar, but anybody who has a dollar, like you could spend that dollar,
yeah,
right? Central bank digital currency, they could, Congress could just say, oh, we're raising taxes and confiscate money. They're
yeah.
saying, like, I mean, PayPal, right, changed their terms and conditions to say if you post something that we consider
Misinformation.
misinformation, we're going to not take $2,500 just from your PayPal account. We're going to do an ACH debit from your bank account and take 25. So you got private companies, have written, someone wrote those terms and services. They said it was a mistake that it was released, right? Someone wrote it. Okay. And even if it got turned on as a mistake, this is where like the left's head is at, right? And they want to move towards the social credit thing where they could just seize money that goes, anybody criticizes the government. So it's a massive, massive threat to free speech. So as we stand now, like Silicon Valley Bank, there's a lot that's like defensible there, and like how it's been handled, like the governmental response to like stem panic. But I would not be surprised if at some point we see broader bank failures and that central bank digital currency come out as stimulus. And I've got to actually jump on a call in like a minute here.
Yeah, you're
Do
good.
you have
Yeah.
anything we want to like wrap up with or?
No. We can wrap it. I was gonna say, yeah, no, CBDCs would be the ultimate coup, right? Because I mean, even just censoring Twitter or something, you could still make alternative accounts, but if you control, I mean, to put it in like biological terms, if you control the flow of ATP, like the currency of energy, that is currency, that's total lockdown. And that does, I don't think we can totally write off the idea that, I mean, if SVB is so incestuous with the current administration, to me that kind of gives more credence to the idea of what if this is engineered? What if this is beginning a collapse so that you have to roll in daddy government?
Well, this would be kind of step two, right? You had like FTX, the
Yeah,
collapse,
yeah,
which
yeah,
was
yeah,
like super in bed with Gary Gensler and the CFTC,
yeah,
right? Then you have all these attacks on crypto, all this like regulation by enforcement to try to like chill that market. Notice, by the way, Bitcoin has been ripping since all this happened, right? So it's actually showing that people don't trust banks and they trust Bitcoin more than they trust, the banks. But then you have, SVB. So I mean, you do, there. I don't think it's that conspiratorial to like kind of draw a line in all of these events and knowing that the ultimate goal of like the World Economic Forum and the globalists is to get people on a central bank digital currency where they can implement social credit.
yeah, and yeah, monopoly on violence and money, and they always say like the U.S. dollar is not backed by anything. It's not backed by gold anymore. It's absolutely backed by the
It's backed by
largest.
the U.S. military.
It's backed by something much stronger than gold, and it's the largest, most sprawled out, global encompassing military in the history of the planet. That's that's stronger than a shiny metal.
And hopefully it stays strong at least. But I'd rather have the U.S. military than the Chinese military. But
Yeah, yeah,
I don't like the trend there. But I
no,
gotta hop.
yeah,
You're the man. Thank you for having me on, and
no,
I will talk to you soon.
absolutely, dude. Thank you so much for doing it on short notice, guys. Go in the description, read the
You're
article
welcome.
about him, follow the social media. James, thank you.